welcome back into the channel. If you are coming back, but if you're new, then welcome. And please make sure that you're subscribed. If you aren't, make sure you like the video, and please leave us a comment of what you want to see next or anything you want to say about the session. If you have any questions, please put them there. Just remember that everything is basically linked in the description. So all the answers that I cover here, I will link them in the description. I'll link the past paper in the description as well so that you guys can check it out. And yeah, without further more to do, let's jump straight into the question. So in this question, we're doing the cash flow statement and financial indicators. So the first question is just on basic concepts. So the current ratio is a financial indicator which is relevant to the liquidity or solvency of a company. Now remember that liquidity looks at the short-term ability to settle debts, whereas solvency looks at the long term, and the current ratio is current assets to current liabilities. Both of those things are in the short term, so then that will be liquidity. So for the first question, we would go with liquidity. Let's look at the next question. An increase in a fixed deposit will lead to an inflow outflow in the cash of cash in the cash flow statement. Now, if you increase your fixed deposit, that means that you take money from your bank and then you go and put it in an investment. So that would be money coming out. So then in that case, we'd say that that is an outflow. So if you are increasing your fixed deposit, it means you're taking out more money from your business and putting it towards some financial investment. Okay, third one, a decrease in inventories will lead to of cash in the cash flow statement. Well, decreasing inventories imply that inventory is being sold, and if inventory is being sold, especially for cash, that basically generates cash. And so in this case, we would then say an inflow. Okay, cool. I hope those were easy for you. If they aren't, then you really need to kind of lock in your ratios and also understanding just the basics of the cash flow. But we're going to go through a cash flow here, so that will be good for us to basically check out. All right, cool. Now let's move into the next question. So the next question that we asked is about Jingle Limited. So it says that the information relates to the financial year ended 29 February 2024. Then the first question is to prepare the retained income note for the financial year ended 29 February 2024. And we can pretty much come in here and see that some of the amounts have already been included in this. And just scroll up as well. Yeah, so you can see some of the amounts that are included already. So then we're going to need to find some other information to basically plug into this. So when it comes to the retained income note, we know that we have the balance at the beginning of the year. The thing that follows after that is the net profit after tax. And then we also have the repurchase of shares. All right. So net profit after tax, I'm going to start there. So the net profit after tax, let's find the information that relates to the profit after tax. So we have share capital information, we have dividends information, and then in number C, that's where they kind of give us the profit because they're giving us income tax, which is at 30%, and we'll be able to calculate profit that way if there's no other thing else given. Okay, cool. So we can use that then because remember that if the income tax is 30%, so we basically understand it like this. So net profit before tax and PBT, we would say that is 100%. And then we would say that your tax, in this case, is going to be 30%. And therefore your net profit after tax is then going to be, so it's 30%. So that's then going to be 70%. So then to work out your net profit after tax, which is what we're looking for here, we're basically going to take our income tax, which is given because the income tax is given as 1,950,000. So we're going to say 1,950,000, and then we're going to multiply by what we're looking for. So we're looking for the net profit after tax, and then we're going to divide by what we're given, and what we're given is the tax, which is at 30%. And so that would be our calculation for the net profit after tax, and that works out to 4,550,000. Okay, cool. Let's move on. Then we have the repurchase of shares. Now, how do we deal with the repurchase of shares in this situation? Well, let's see the transactions that would have triggered the repurchase of shares. So let's look at the first information. So that first information there, we're given the number of shares at the beginning of the year, and then we're told about 30,000 shares that were repurchased on 1 June 2023, so somewhere within the financial year. And this is done at 3.7 above the average issue price. So regardless of what the issue price is or the average issue price is, but it is basically repurchased at 3.7 above the average issue price. So the way we're going to do it then is that we're going to take the 3.7 and then we're going to multiply by the 30,000. So this is how it's going to work. So let's take the 3.7, which is the above average issue price. Remember that the issue price, the average issue price, is set off against ordinary share capital, but then against retained earnings, we take the amount that is in excess of the average issue price. So then it's just going to be 3.7 multiplied by the 30,000 shares. And so that will work out to 111,000, and then remember that it would be a negative amount. All right, cool. And then moving on now to dividends. So the final dividend is already given, but then we need to basically work out the interim dividend. So when it comes to the interim dividend, let's look at the information we're given in B. So the information here says that interim dividends were paid on 31 August 2023 to all shares in the share register. All right, so we need to then look at 31 August 2023, how many shares were in the register, and then figure out, well, how much was actually paid towards those. Let's see if we can be able to find that information. So let's see. No information in terms of how much per share, but let's see then where we can find this information. Let's see. Okay, not very clear. So we have current assets, current liabilities, retained income, not given, and then we have inventories, cash and cash equivalents. So the interim dividend, then we don't have information that relates to it, so let's come back to it at a later stage. And then because we don't have that, the interim dividend, then it means that we cannot have the total of ordinary share dividends, and therefore you cannot have the balance at the end of the current period. Okay, cool. So let's have a look in terms of maybe we can get information about how much was paid towards dividends altogether, and then that would help us. So let's see, first information, there's no mention of the amounts, and then we have the final dividend that was declared. We have the operating profit, and we have the shareholders' equity beginning to the end of the financial year. And then we have inventories, cash and cash equivalents at the beginning and at the end. Then we have shareholders for dividends, which we can see here that there was this payment of 2,338,000. And then let's see. All right, so that would be the retained income. Then we move on to cash effects from operating activities. So cash effects from operating activities, we got our interest paid, we got our dividends paid. Now, this is where we basically get this information that allows us to calculate the interim dividend, because the answer sheet gave us the total amount of the dividends that were paid. So if this amount was paid towards the dividends in the current year, well, that would mean that there was a payment towards the dividend at the beginning of the year, and then also the dividend. That would be the payment towards the dividend, the shareholders for dividends at the beginning of the year, and then the interim dividend. So what you're going to do then is that you're going to take that amount, you're going to say, well, 5278,000, then you're going to say subtract. So you're going to subtract then shareholders at the beginning of the year. So let's see, shareholders for dividends at the beginning of the year was 2,320,000. 2,320,000. Remember, guys, when we talk about dividends paid, we're essentially talking about the dividend from the previous year, which you would get as shareholders for dividends at the beginning of the year, and then we'd also be talking about the current year interim dividend. So if you paid 5,278,000 and there was an interim dividend of 2,320,000 at the start of the year, that means then that 2,958,000 was basically be paid towards the dividends. And so our total for ordinary share dividends in the current year will then be the addition of those, and that gives us 5,296,000, and we just need to make sure that is negative. So we need to make sure that is negative, and yep, it is negative. And let's see. Yes. All right, cool. And therefore, the balance at the end of the year for the retained earnings, we're basically going to just be adding up these amounts, and then we get the amount at the end. All right, cool. So that would be the first part done in terms of doing the retained income note. Okay, cool. Now let's move into the cash flow statement and basically answer some of the questions that relate to that. Now let's look. We're given the answer sheet here, and it's right here, and you can see that we had five. Okay, so there's a mistake that was made there because I said 5,278,000, but it's 5,728,000. Sorry about that mistake. So 5,728,000. And then we basically need to change it there as well. So 5,728,000. And so that changes the totals, and therefore we have our balance now at the end as being 1.5 million. All right, then we move on to, so the questions that have been asked here as it relates to the cash flow statement are basically the ones that are numbered because it says refer to the partially completed cash flow statements, calculate and or provide figures denoted by number 1 to V. So let's start with number 1 then. So our number 1, if we look at it, so we have interest paid, dividends paid. So that can only be referring now to what? We're going to replace with tax paid. Okay, now looking at the tax paid, let us look. So we're going to look at the beginning of the year, was the tax owing to SARS or owing by SARS? So let's see. So at the beginning of the year, let's find taxation. So we have our current liabilities and current assets, and then we get more information on those. So there we go. Under our current liabilities, we have SARS income tax. So SARS income tax, 86,000 at the beginning and 115,000 at the end. Now in this case, they weren't very specific in terms of whether it's credit or debit, but the default that you go with is basically the fact that it would be a credit. All right. So then to start off, we look at the 86,000. So the 86,000 was owing to SARS at the beginning of the year. So by the end of the year, that amount would have been paid. So we say minus 86,000. And then after that, we also just straight up subtract our income tax for the year, which is 1,950,000. And then off that income tax of 1,950,000, you can see that 115,000 of it is still owing. So if that 115,000 of that income tax is still owing, that basically then implies that that payment is yet to be made. And so would basically then just add that 115,000. And then we would have our income tax paid as 1,921,000. Okay, and then we'll move into number 2. So we have cash effects from investing activities. So it proceeds from sale of fixed assets. And the next thing, therefore, is going to be proceeds from sale of, not from sale, but this would be the purchase of fixed assets. So purchases of fixed assets, let's look at that in detail. So let's see then if we can work that out. So basically, we basically use the basic idea of the fixed income note. So if you think about the fixed income note, we typically take the carrying value at the beginning of the year. So I'm going to call that A. So we usually take the carrying value at the beginning of the year. And then we would add our additions at cost. So I'll name that B. And then you would subtract disposals at carrying value. And then you would subtract the depreciation. And then that would give you your fixed assets at the end of the year. So in this case, what are we trying to work out? We're trying to basically work out the additions. So then if we're working out the additions, it means that we basically take the balance at the end, and then we take all those other things to the other side of the equal sign, so that that would then be B is equal to E, end of the year, minus our beginning of the year, minus minus the beginning of the year, yes, minus the beginning of the year, plus the disposal, and then plus the depreciation, and that's basically going to give us what we're looking for then. So let's do that. So the balance at the beginning for fixed assets, let's go and find it. So fixed assets at carrying value, 39,365,000. So 39,365,000. Then the next thing is then to say, okay, 39,365,000. We then will need to subtract, okay, cool. I think I've done this wrong. We're going to start with the balance at the end, which is 43,095,000. So we're going to say 43,095,000. Then we're going to say minus the amount at the beginning of the year, and then we're going to add our depreciation and add our disposals. So our disposal is already given there as 232,000. So we're going to add that in, and then what you're going to do is to then also add, add the depreciation. So we just go find our depreciation expense, and our depreciation expense is 1,620,000. So we add that to. Okay, and so basically by using that formula, we are able to basically work this out. So that works out to 5,582,000. It's just basically working backwards. So you start from the end of the year, you're going back to the beginning of the year. But then obviously, because you're looking for either in the examples that you're going to be doing, we're either going to be looking for the disposal, or we're going to be looking for the purchase of fixed assets. And so you need to be able to basically make whatever that you're looking for the subject of your formula. And at some point, I think when we're covering paper 2 questions, we're going to do a detailed fixed asset note. And then I think this will make even more sense if you don't understand already. Just please let me know in the description, in the comments below, if you're getting it. Let's move on then to the financing activities, where we have our number 3. So our number 3 and number 4 are in the financing activities. So we would look maybe for things like this: proceeds from shares issued, and then also money that is spent repurchasing the shares. And I think that from the information that we already got, there was a repurchase of shares. So we'll need to figure that out in terms of how much that will affect our cash flow statement. So let's see the information. So let's start with the shares. So we know that 250,000 shares were issued on 1 November, 17 Rand 20. So that's fairly straightforward then, because we're just going to say 250,000. So we're firstly going to say proceeds from issue of shares. So those proceeds from issue of shares then work out like this. So we're going to say 250,000 multiplied by 17.2. And then that works out to 430,000. I think it should be 4 million instead. I left one more zero in my calculation. Yes, I left one more zero, so that works out 4.3 million. Okay, and then after that, we then would look at the repurchase of shares. Okay, so the repurchase of shares, now we have to think about the fact that there was an average issue price and then there's the above average issue price. So what was the average issue price at the time that there was this repurchase of shares? Because when it comes to the cash flow, we don't split. We basically take whatever total was paid, regardless of whether it was below or the same or above the average issue price. Okay, but we do know from the previous question, right, that 111,000 was paid because that's the amount above the average issue price. But then now we basically need to then figure out, well, what was the average issue price on that day? Now, how do we figure that out? Fairly simple. Why? Because we know the shares. We know because when you calculate the average issue price, you look at your ordinary share capital before you do the repurchase. So the value of ordinary share capital, then you divide by the number of shares. So before the repurchase, there were 1,450,000 shares, and they were corresponding with the share capital amount of 22,910,000. So if you then take that 22,910,000 and then divide by those number of shares, that will give you the average. So that average issue price is basically then going to be our 22,910,000, and then divide by 1,450,000. So that works out to 15.8. So then we're going to say, well, the repurchase of shares will be 15.8, which is the average issue price, multiplied by the number of shares that were repurchased, and 30,000 shares were repurchased. And then in addition to that, we will add the 111,000. And that gives us basically the total that was paid to repurchase these shares. And do remember that when you put this into your cash flow statement, it is a negative amount, which is 585,000. So that would be number 4. And then lastly, we have our number 5, which is basically, so once you get your net change in cash and cash equivalents, you then would take your cash and cash equivalents at the start of the year, and then you do cash and cash equivalents on the last day of the year, which was 29 February 2024. All right, and then you would work out this number. So how do we work out this number? Well, we go to our cash and cash equivalents, and then we also go and check if we have a bank overdraft. So let's have a look then. So looking here, we have our current assets, current liabilities. Now, our current assets at the end of the year, you can see that it's 55,000. And then if you look at our current liabilities, we have 3,274,000. So basically, we have a negative amount here because ultimately 55,000 on hand, but then we have an overdraft of 3.2 million. So then to work this out, we would say, well, minus 3,274,000, and then would say, well, to that we add a balance of 55,000, and so our cash and cash equivalents at the end of the year, I think I overdid the zeros there. Let's take off 10. That works out to 3,219,000. Okay, hopefully that makes sense. And then let's look at the few questions that remain, and it's basically just a few ratios that we need to calculate. So firstly, asset test ratio, and we don't need to comment, we just need to work it out. So asset test ratio. So for the asset test ratio, we know that we'll take current assets minus our inventory. So let's have a look at our current assets first. So current assets, we got 9,623,000, and then we need to subtract what belongs to inventory. So inventory of those current assets is 4,190,000. So we're going to take then that 9,623,000. So we're going to show it like this, that we have 9,623,000 minus 4,190,000. Right, and then we're going to say asset test ratio, and that will be to our current liabilities. Our current liabilities, what do they work out to? You can see there that it's 18,310,000. So 18,310,000. Okay, so that then basically works out then to 5,433,000 is to that. And so if you really do work out the ratio, that is basically going to be 0. Okay, cool, I'll round that off. And that will be to 1, because we basically divide by the 18 million on both sides. So if we just round that off, that will round off to 0.3 to 1, depending on how much you're rounding. So that's 0.3 to 1 asset test ratio, fairly straightforward. Then the next thing that you're going to be looking at is the interim dividends per share. So interim dividend per share, well, for interim dividend per share, we will take our interim dividend, which we worked out in the previous question, because we had an interim dividend of 3,408,000. So 3,408,000. Then you divide by the number of shares that were in issue at the time that the initial the interim dividend was paid. So if we look at the information here, it says that the interim dividend, which date? It was 31 August 2023, and that is after these shares were repurchased, but it was before there was an additional amount of shares issued. So then that would mean that the number of shares that were issued on that date that the interim dividend was paid would be 1,450,000 minus 30,000, which would be 1,420,000. So you're going to say 1,420,000, and so that would then be 2.4, or if you don't want to write it as 2.4, you can say that it's 240 cents per share, because you can just take that 2.4 multiplied by 100, and then you will get your number in cents. So it depends, how you want to present it. All right, and then we look at the next ratio to calculate, which is return on average shareholders' equity. So return on shareholders' equity, so there we basically just take our net profit. So we're going to be taking our net profit after tax Remember, we have this net profit after tax that we already worked out here, and then we'll divide by average equity. So to do this, let's just write some of this thing down. So the net profit, so some of the things that we need, net profit is, from the previous calculations, you know it's 4,550,000. And then the other thing that we do know is not know, but the average equity. So average equity means that we're going to take our shareholders' equity at the beginning and at the end of the financial year, and then we'll multiply it by 0.5 or divide it by 2. So what is our let's look at the share capital then at the beginning, 25,279 plus 28,248. So that is going to be 25, I think 729,000 plus, let's look at, so 27,925, 25,729, yes. 28,248. So 28,248. Then multiplied by 0.5. So that's basically just dividing. So that's going to be that. And I want to just move this one here actually, so that it's kind of like in the same thing. So then to work out the average, the percentage return, we're basically going to take our net profit. So we're going to take that net profit of 4 million, and then we're going to divide by this average equity, and then you multiply by 100. I'm using an Excel, so I can just switch to percentage mode, and it gives us 16.86%. And that is basically how we would do this question, and I don't think there's any other questions left in question 2. So in our next video, we're going to be looking at question 3. So make sure to stay tuned, make sure you're subscribed and sharing the channel with some of your peers, and we shall convene again in the next video. Cheers for now.